Thank you for joining us for today's webinar on year-end accounting planning and preparation. I want to start the webinar with a few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. You'll see a chat box that you can use to enter those questions. Just type the question in and click submit. Our presenters will answer those questions at the end of the webinar as time allows, or afterward we can follow up with you personally. Next, let's modify those audio settings. If you're using your telephone, please click on the phone call audio option, or if you're listening through your computer, then please click on the computer audio option. Now a quick review of California CE requirements. To qualify for California CE, you must use a personal computer, no smartphones, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There will be 4, which means you need to answer 3, and you must complete the evaluation survey at the end of the webinar. And now a quick intro to today's excellent presenters. We'll start off with David Miller. David is the director of our outsourced finance and accounting practice with more than 25 years of experience providing superior client service and support to emerging and growing businesses. He focuses his expertise on business needs of clients and translating those requirements into actionable financial and accounting solutions. Next up, we have Scott Schwartz. Scott leads our evaluation and equity management solutions practice here at Erminino. He's worked with hundreds of clients, private and public, providing financial and consulting services, as well as working directly with entrepreneur, oh my gosh, I can't even do it,
entrepreneurs, Scott. That's okay.
There you go.
That's fine.
We have, he's got extensive experience in equity comp and valuations, and he's pretty awesome. So you'll hear from him in a few minutes. Now our learning objectives. So we will discuss key compliance requirements and forms, analyze year-end tasks to prepare for your 2017 audit, review current processes and identify areas of internal controls and compliance improvement, and identify the key components of a successful business plan for 2017. Quick highlight agenda. We're going to go through these 3 topics: year-end compliance issues, year-end audit considerations, and business planning. But before we get started, we'll have a quick polling question. So a reminder, I just went over those CE requirements. You need to answer 3 of the 4 polling questions, and that's fine. So first polling question is going to be, what are your top financial concerns heading into year end? Is it A, understanding new or updated compliance requirements, B, understanding tax consequences related to equity compensation, preparing for your 2016 year-end audit, not mine, understanding cash flow requirements for 2017, or E, all of the above? Make sure you get those answers in. Again, you need to answer 3 of the 4 questions for CE. And for those of you, we're going to be going over a lot of information, so I will be sending out these slides following the webinar. Get those answers in. We'll close the polls in 3, 2, and 1. Looks like about 50% say all of the above. Next up was understanding new and updated compliance requirements. Good thing we're having this webinar, gentlemen.
Yeah, David, that's right up your alley there. Also, looks like about 20% in preparing for the 2016 year-end audit. So,
yeah, interesting. Not people too concerned about planning out for 2017. I guess everyone's focused on closing out the year. So that's completely understandable.
All right.
So, shall we jump into some of the year-end compliance? Excellent. So let's get warmed up and start with some payroll. So what's changing? Until now, employers had 3 dates to keep in mind when remitting W-2s. Previously, they had January 31st to get employees their copies, February 28th for paper filings to the SSA, and March 31st for electronic filings. Now, beginning with 2016 forms, employers will now have 1 filing deadline for all federal W-2s. That deadline is January 31st. Now, this is true for both employee and agency copies, whether filing paper or electronic returns. Now, some of the state filing requirements, vary by state. You should just double check if you're outside the state of California what the requirements are. If you're unable, so one other thing to keep in mind, if you're unable to make the deadline of January 1st, you need to file the Form 8809 to request a 30-day extension. So even if you can't make, if you've got a lot to prepare, a lot of year-end deadlines, you can still file the 8809 to get a 30-day extension. And you should also note that some of the penalties have increased. So if you fail to file the W-2s on time, the IRS can assess a penalty of up to $30 per W-2 if you file the correct form within 30 days of the due date. If you file the form between 30 days of the due date and August 1st, the fine will go up to $60 per form. There are some maximums on that as well for large and small businesses. Okay, let's talk about 1099s. So as a reminder to everyone out there, the 1099 form is a series of documents the Internal Revenue Service refers to as information returns, right? There's a number of different 1099 forms or 1099 boxes that report the various types of income you may receive throughout the year other than salary that your employer pays you, right? So the big change is really around the non-employee compensation. As a reminder, non-employee compensation relates to amounts that are paid to independent contractors, and the threshold for the amount is $600 or more on an annual basis. So the legacy filing deadlines were January 31st for recipient copies, February 28th for paper filings to the IRS, and March 31st for electronic filings, similar to the W-2s. Well, all those deadlines have now accelerated, and everything is due on January 31st. So the recipients must be e-filed or postmarked by January 31st. The paper IRS filings and the electronic filings paper filings must be postmarked by January 31st. Electronic filings must be delivered by January 31st. And again, if you have a challenge hitting this deadline, you can file the Form 8809 to get a 30-day extension for the deadline. And then there are penalties. Late filing of mandatory 1099s could lead to penalties ranging from $30 to $100 per 1099, with a maximum of $500,000 a year for a small business. If there are intentional misses, like if you just don't file at all for whatever reason, the penalties go up to $250 per form. So pretty severe costs, particularly if you've got a lot of business with a lot of contractors. Okay, let's talk about ACA, right? The Affordable Care Act.
Hey, David, real quick.
Oh, sure. Go ahead.
We had a question. March 31st is the deadline for electronic filing. Is that the clarification there? Filing with the IRS as opposed to submitting to the employee? Or you're talking about if it doesn't, just to clarify, there was a question. If it doesn't have box 7, then you can still file by March 31st, right?
That's exactly right. Yeah. If it's not non-employee compensation, it relates to rents or royalties or any one of the other categories that are on there, that date is still March 31st for the IRS filing.
You're welcome, Melissa. Thank you for the question. Yeah, and so if you do have questions at any point, please feel free to reach out. If we can, we'll try and get to them. Sometimes we have to wait till the end, or we'll respond after the webinar is over.
Okay. So just going back to the ACA, so who qualifies, right? So basically it's employers with 50 or more full-time employees or full-time equivalents. So if you've got 100 part-time people, you may still qualify for the ACA. One of the big requirements that's changed during the course of the year is the number of employees that are must be insured has increased from 75% to 95%, and also they have accelerated the deadlines. So let's go to the next slide and talk about some of the deadlines. So who gets what? So the employees get the 1095-C. This basically outlines the coverage that's been offered to the employee, what type of coverage it is. You must send your employees their 1095-C by March 2nd. Now that's earlier in the year. The due date was January 31st, so that's a fairly recent change. It was changed just several weeks ago. So the due date is now March 2nd, 2017, not January 31st. And the IRS goal date is, over time, this date will get accelerated. The goal is for the filings to happen on January 31st. They're still giving us a little bit of leeway as companies get this up and running. The second one is the IRS, the 1094-C. This is essentially a cover sheet for all the 1095s. It provides information about the employer, including the address and phone number, how many employees, the key contact people, and how many 1095-C forms are being sent. You must send the 1094-C by February 28th for a paper filing or March 31st for an electronic filing. There's no extension for this year. Last year, this form was due on June 30th. And then there are penalties as well. As you can see, the penalties can be pretty stiff. They can be up to $260 per return, so it's important that these get filed on time. And it should be noted there are a number of services, and in any one of these there are electronic filing services and tools out there. Certainly if you have any questions or need some guidance on that, you can consult with your accountant or any professional service provider. All right, let's quickly move on now to the Overtime Act. Right? So the overtime, this is not a sports rule. This is an employer-related rule. Sorry, a little joke there. So essentially what's happened, what was proposed was that the ceiling for overtime or ceiling for exempt status qualification was essentially doubled and was targeted to go into place on December 1st. So basically, anybody, for an example, anybody who was paid $30,000 last year and was incurring overtime, if they were a salaried employee, you wouldn't have to pay them that overtime. Now, under this new act, if they were incurring overtime and getting paid around a salary of $30,000 a year, you may have to incur, depending on the amount of overtime, anywhere from as much as 10-15%. If they're working 4 to 5 hours a week of extra overtime, that's going to be 10 to 12% more in salary. So that can have a big impact, particularly on some smaller businesses. However, let's go to the next slide. This has been blocked, right? So I'm sure most of you know this. We've been keeping up to date with this. It's still, the injunction is still in place. There's one thing to consider here. You may have already made some of these changes, so have adjusted salaries or adjusted your approach with certain employees. If you've done that, I would keep it in place. I'd recommend keeping it in place at this point. If you haven't made any changes, I would wait until this litigation is resolved. And when will be final, we really don't know. And again, consult with an accounting professional. We can certainly help you, professionals can certainly help you do some cost-benefit analysis and kind of determine what is best for your business.
Yeah, and I think the key here with all these filings, and we're going to talk about some equity-related filings, is to file them, right? Whether you file them late or not, make sure you do file them. Obviously, you can decide to take the risk by not filing, but it's definitely recommended to file. The penalties are not automatically assessed, right? It's the IRS. It's up to the IRS to come and enforce those and assess them. So we're talking about Section 6039 of the IRS code. We're talking about incentive stock options and employee stock purchase plans. So the qualified equity compensation that you can grant out there. So if somebody has exercised an incentive stock option, or they have purchased in an employee stock purchase plan, again, mostly applicable to public companies out there, then you have to provide the employees with an information statement as of January 31st. So it's pretty straightforward, should be along with your W-2s, except for this may be not a standard item like your W-2. Oftentimes we find clients either haven't reported this to their employees in the past or haven't reported it to the IRS. And again, you should If you do a paper filing, you have to file by February 28th. If you do electronic filing, by March 31st. And again, there's some penalties for not filing or for delaying to file. I'm not going to go through those, but again, I think it's recommended best practice is to file even if you do file late. You can also ask for an extension as well. The employee statements is for the employees to help do their AMT, the alternative minimum tax calculations, which is applicable to the incentive stock options and those ESPPs. Again, talking about the ESPP, it's a slightly different form. So the ISO, the incentive stock option is a 3921. For the ESPP, it's a 3922. If you do use an outside vendor, just make sure you get a contract in place, ideally before the end of the year, so that they can provide the employees information statements and make sure that they can meet all of those deadlines for you. Another item in thinking about kind of payroll or equity compensation related is disqualifying dispositions related to incentive stock options as well as employee stock purchase plans. So I'm not going to go into a ton of detail, but in short, right, a disqualifying disposition occurs when a employee sells their incentive stock option shares, right? So they've exercised an option, an incentive stock option, and they sell it within 1 year from exercise or 2 years from grants, whichever is longer. And the same is true for an ESPP. The difference is the grant is the beginning of your offering period, and instead of, quote, exercise, it would be the purchase. So if somebody exercises an option 6 months after grant, if they sell it within the next 18 months, that would be a disqualifying disposition because they'd have to wait 2 years from the grant date to have a qualifying disposition. So as an employer, you're required to report W-2 income for any disqualifying dispositions. That's ordinary income. Normally an ISO exercise and an ESPP purchase are qualifying transactions, right? They don't have a taxable event upon the exercise or upon the purchase, other than AMT, which we won't get into, but again, applies back to the 3921s and 3922s. But for you as an employer, you should be sending out, or maybe you're tracking it, either sending out a survey or tracking who has sold any of their ISO shares or their ESPP shares. If you're a public company and you have an ESPP, typically your broker tracks those ESPP shares, so they should be able to give you a report of if any of those are disqualifying disposition. Potentially they can do that for, excuse me, for ISO grants as well. See one question, the form, what is the form for IRS section 6039? So the form, so the section, the IRC code, the IRS code is 6039. The form itself is called a 3921 for option exercises, incentive stock option exercises, and 3922 for employee stock purchase plan purchases. There's another question. What are the reporting requirements for ex-employee sale of shares? Again, if that employee has sold incentive stock options as part of their shares that they sold, you still have the same reporting requirements, whether they're an ex-employee or employee. If somebody does a disqualifying disposition of an ISO exercise, that should be reported as W-2 income. You don't have any withholding obligation like you do with a normal kind of ordinary income transaction, but you do have to report that income in the year that they sell it. So for example, if they exercise this year and sell next year, you would report it as income in 2017, or conversely, if they exercised last year and sold this year as a disqualifying disposition, you would report that as income this year. So again, we're talking about a lot related to equity comp, and these are some of the payroll considerations to think about and preparing for year end is the W-2s and making sure the W-2s match up with what you've recorded as far as transactions that have occurred. So just as a quick recap, for general transactions, right, we talked about disqualifying dispositions just a moment ago, which does have a W-2 impact. But for a non-qualified exercise, for a RSU vesting and release, those are all taxable events that require you to record, A, withhold taxes at the time of the transaction. So hopefully you're doing that. But B, also then report that income, that ordinary income on the W-2. I want to say it's box 5, but don't quote me on that. I'm not an expert on the W-2 itself. So make sure that you run a report to review all of your exercises, all of your vestings, and make sure that that ordinary income is aligned with your payroll provider, or if you're doing payroll internally, make sure that your systems, your equity system and your payroll system are aligned in order to provide your employees with the proper W-2, and so you don't have to amend it. Again, same thing, just making sure that your rates are tied out. So a lot of times clients will transact ordinary income, right? RSU releases, option exercises. They'll calculate the taxes in payroll, right? But a lot of your forms and your data, right, that you might be providing to employees, or they might be logging in and seeing in their participant portal, might be going through the equity system. So at the year end is a great time, if you're not doing it more frequently, is a great time to align your systems. Make sure your equity system is tied out to your payroll system and vice versa. Again, if you can provide details throughout the year, I think that's best practice, but a lot of times folks wait till this is, at the end of the year and sort of an item to true up and clean up and reconcile. With non-U.S. employees, the reporting requirements are vastly different, or I should say there's a huge amount of variety. In some cases, they might be the same or similar to the U.S. In other cases, they could be very different. So you really need to look and work with your partners in those countries that you're working with. Almost every country does have some sort of reporting requirement at the end of the year. So you want to make sure you have that tracked. I see a couple of questions. Do we have to report non-qualified stock option early exercise? So yes, a non-qualified stock option is a taxable transaction. If it's early exercise, there may be no ordinary income, because the income that you calculate is the difference between this. It is the spread between the market price at the date of exercise and the exercise price. So typically, when an individual early exercises an option, the strike price, the exercise price, and the market value are the same. Thereby, there is no taxable income, right? There is no ordinary income at that point in time, and therefore you wouldn't have a W-2 amount to report. Just a quick note on that, and then we got to keep moving. If you have folks that are early exercising, hopefully they're also, and again, not giving them tax advice, but typically you want to file an 83B election, which then accelerates the taxes to the date of early exercise and doesn't cause a future tax liability. So I'm not going to get into the details of that, but if you have more questions on that, or if I didn't answer your question, please let me know. We'll go ahead and move on to the next slide. One last question, non-qual sold during the year. Again, you've already recorded ordinary income based on when that non-qualified stock option was exercised. So you don't have any other reporting obligation when the shares are sold. Your participants will have either a long-term or short-term capital gain, but you don't have a reporting obligation on that. A lot of questions. David, turn it back over to you.
Great stuff, Scott. Great stuff. So here's just to wrap up some of the compliance considerations. Here's sort of a high-level checklist, and I'll just run through it quickly. I think, sure you're all familiar with some of these, but it's really important just to kind of take an inventory of your documentation, supporting documentation for various parts of your business. So make sure that you've got W-9 forms for all your vendors. This is a great time of year to be able to just take an inventory and make sure that you've got all the support you need, particularly for your 1099 filing requirements. If you're doing business to business and business to consumer sales, make sure that you've got resale certificates on file for customers who are resellers of your products, right, so that you're not liable for sales tax liabilities. Make sure all your state registrations are up to date. Also think about, have you recently expanded into new states or municipalities? Is your sales tax registrations and your filings all up to date, particularly with respect to the business registrations and the sales tax registrations? Have you moved locations or are you doing new business in a new municipality? So it's also important just to check on what the local registrations and requirements are as well. And then a couple other things, particularly here in California, particularly in California, is the property, the business property tax filings, which are typically later in the year. But this is really a good time just to make sure that you've got the proper documentation around your asset register. Your asset register for your property, your equipment, furniture, fixtures. Everything's properly documented and supported. Of course, you'll have that going into the end of the year with respect to depreciation and some of those things as well. But it's just good to make sure you've got all these checkpoints. Okay. So let's hit the next polling question.
Thanks, David. So polling question 2, again, if you're here for CE, you need to answer 3 of the 4. So if you missed the first one, make sure you get on with this one. How well do you think your employees understand the tax consequences related to equity compensation? A, very well. B, well enough. C, average. D, not well. E, not at all. And again, I know we're going through a lot of material. We'll have the recording and the slides of the webinar available after the presentation. So if you've missed anything or want to check back, don't worry, you'll get those after the webinar. And get those answers in. We'll close the polls in 3, 2, and 1. It looks like 47% not well, 35 average.
Yeah, not surprising. And definitely we've seen a lot of questions from the audience, which is great. Just always want to throw it out there, right? Each tax situation may be different or unique. We're providing kind of the general overview and hopefully answers that are applicable to you and helpful. We're not surprised by that response. We actually go in and help clients do employee education to understand tax consequences of both, employee stock options, RSUs, ESPP, and all of that stuff. The 5% that think the employees know it very well, that's great. Hopefully you've done some education at your company to help your employees know it well, or perhaps you're granting, maybe at a higher level. We typically see for broad-based equity plans, probably that average and not well is pretty standard. So in thinking about kind of year-end considerations, we're going to talk first about and kind of get into some depth around equity compensation considerations, which there is a number of them, and we'll touch on maybe a little bit more general ones as well. There's a couple of policy elections that we recommend reviewing at year-end if your fiscal year is a calendar year-end, and we'll go through these in detail. But talking about the requisite service period, amortization model, and then what valuation methodology you're using, we also recommend that you review your assumptions that go into that valuation model. And lastly, there's some new guidance out there. Hopefully everybody's heard about it. For private companies, you can decide to early adopt January 1st, 2017. For public companies, you'll have to adopt it as of January 1st, 2017. So talking about requisite service period, this has become a hotter and hotter topic in the last few years, maybe 2 or 3 years. Historically, so what we're talking about is how do we record expense? Do we record expense starting from grant date, or do we record expense starting from vesting start date? Nothing that I'm going to say, by the way, says that you can't grant grants with a vesting start date preceding grant date, i.e. you have a grant that starts vesting on somebody's hire date, and then the board grants the awards maybe 1-2 months later. Hopefully it's not 6 months later. That's pretty standard for our private clients. But what we're talking about is how do we record the expense in the cases where that does actually happen. So first and foremost is making sure that we have the establishment of a grant date. So typically that's going to be your board approval date, but you do want to make sure that you have employees accepting awards within a relatively short period of time after that grant date, that board approval date. Otherwise, you can run into some accounting issues. So once we have a grant date established, the question is, when do we start recognizing expense, and how, more importantly, how do we amortize that expense? So historically, a lot of folks, if we had a vesting start date that was 3 months prior to grant, and let's just keep it simple, we had a 12-month cliff vesting, right? So the option vests at the end of 12 months. We would record 3 months on grant date for that past 3 months of service, and then we would record 1/12 over the next 9 months, right? So ultimately, we'd be recording 100% of the expense at the end of 12 months. So that's kind of the old method. It's still acceptable. We still see clients that utilize that. But I will tell you that the SEC and the Big Four have kind of shifted away from taking that catch-up, that 3 months of expense. So we're talking about, in this case, 3 out of 12, 1/4 of the expense, 25% of the expense, away from taking that on grant date. Instead, recognizing that expense from the grant date to the vesting end date, right, to the 12-month cliff, right? Or actually, it's technically a 9-month cliff. So instead of recognizing 25% and then 1/12 for the next 9 months, recognizing 0 on grant date and 1/9 per month for the next 9 months. Ultimately, you record the same amount of expense, right? You're still going to record 100% of the expense if the employee ends up vesting in the award. The question is the timing of that expense, and ultimately when you record that expense. Again, so that's something to consider if you are considering changing methods and adopting sort of the newer grant date method. Again, this is, when I say new, this isn't FASB or GAAP defined, if you will. This is just the general practice. We've seen that auditors accept both methods, but they are shifting a little bit more, especially if you're a later stage private company, or if you're already public. Hopefully you're already kind of utilizing that method. So if you are going to switch, do an analysis before switching. It's definitely not the simplest thing to just flip over, but what you're going to end up doing by switching is actually taking a smoother expense. So instead of having a big hit on grant date, right, for that 25% of expense on grant date, you're going to smooth that expense over and take a higher rate per month going forward. So that's another item to consider. Obviously, if you have shares that vest on grant, you have to record expense for what vests on grant. We're not talking about changing that. We're really talking about the difference between taking a catch-up on grant date versus smoothing that expense over the remaining service period. Another policy election, and again, this is clearly defined in the guidance, is whether you want to record expense on a straight line basis or a graded basis. Straight line is the most common and the simplest to apply and recalculate. So if you are using a system, it's going to be easier to calculate expense using straight line, but it's going to be an even allocation of expense. So in our example, let's assume the vesting start date and grant date are the same day. We're going to record 1/12 per month. Now let's say there's 2 tranches, right? So now it's a 24-month vest. We're going to record, but it's 2 tranches. We're going to record 1/24 per month. Pretty straightforward. For graded, it's going to front load the expense. So graded amortization actually treats the award as if it were 2 separate grants. One grant that vests after 12 months and one grant that vests after 24 months. So you're going to end up recording 50% of the expense, right, in the first year, plus another 25% of the expense. So 50% is 100% of that first year's tranche, right, that vests after 12 months. And the 25% is half of the second tranche, which is 50% of the total expense. Half of 50% is 25%. So you're going to end up recording 75% of the expense in the first year and 25% in the second year. So that's why the graded expensing is front-loaded. If you're familiar with the double depreciation, it's analogous to that. If you're thinking about assets and depreciating assets on a faster rate, that's kind of what graded expensing does. I'm not going to touch too deeply on single life versus multi-life. Most of the clients out there that we have are using single life. Multi-life forces you to value each tranche as if it were its own grant. Again, not a recommended complexity to implement. And I would recommend using single life straight line. That's the norm. If you, for some reason, want to front load or recognize more expense, then you might use that graded expensing. But I would still recommend using single life, where you only have to value that award one time. Now, talking about expected term. So most, and now we're kind of getting into the fair value assumptions, right? So most companies use Black-Scholes to value their options. You can also use a lattice model or Monte Carlo. Again, I would only recommend utilizing those if you have to. If your awards are complex in the way that you can't use Black-Scholes, meaning that maybe you have some market-based conditions built into your options, or if they're tied to a liquidity event, something like that might cause you to have to use something other than Black-Scholes. My rule is to keep it as simple as possible. Make sure A, the employee understands what they're getting, but B, the administrator and the accountants can do the expensing properly. So keep it simple. Ideally use Black-Scholes. In using Black-Scholes, we have kind of three main inputs: expected term, volatility, and the risk-free rate are kind of the main ones. The risk-free rate we're not going to talk about. That's pretty straightforward. In the expected term, we recommend that you review at least once a year whether you need to use something other than the simplified method. The GAP allows us to use a simplified method, which is a theoretical calculation of the average of the vesting period and the contractual life divided by 2, right? So the average of those two. It's very simple. If you can use it, I would recommend using it as long as possible. But if you do have 5, 10 years of history, you might need to do a calculation of a historical expected term to see if that is more indicative of what your employees, how long your employees are holding your options. Just to clarify, expected term is the expected amount of time that you expect your options to remain outstanding, right? So how long do you expect until an option gets exercised? So you should review that at least annually, and probably write up a memo if you're on an audited company, write up a memo for your auditors, outlining your analysis. On the volatility side, if you're a private company, you're probably using a peer group, and you should, because your price isn't changing daily or probably recent enough to have its own volatility. But I would say don't just use the 409A volatility, right? Your 409A, your valuation may have a volatility that's tied to a 2-year time to liquidity, but your options, your expected term of your options might be 6 years, right? The standard 4-year, 1-year cliff option, if you think of that, about that simplified method, has a calculation of 6.08. You might simplify that to 6 years, right? So 6 years versus maybe 2 or 3 years, those two aren't aligned. And the guidance says that our volatility, our peer company volatility, or if we're using our own company volatility, should align with the prices we use, should align with our expected term. So make sure you don't just take your 409A and say, oh yeah, that's 90%. We're going to just drop that in for stock-based comp purposes. That's not going to be accurate. The other thing to consider is maybe some of your peer group, your peer companies in your 409A don't have enough trading history, right? So you may have peer companies that only have 2-3 years of trading, but you might have a 6-7 year expected term. So you have to analyze that. And again, that's something that we recommend analyzing at the beginning of every year going into the next year. If you're a public company, obviously you want to utilize your current volatility. If you have been public for more than 2 or 2.5 years, that's kind of the line in the sand that the FASB sort of says, hey, if you're earlier than this, you probably should still be using a peers or maybe some sort of blended rate where you blend your peers in with your own volatility. Again, something that you'll want to review or probably include in a stock-based comp memo as part of your year-end process. So getting the forfeiture rate, we recommend also, again, reviewing this once a year, hopefully not more than once a year. If you're a public company, you might have to review it quarterly. we're big advocates of keeping it simple, and unless you've had a layoff or you've had a big exodus, maybe your forfeiture rate probably hasn't changed quarter to quarter, but it's something that you potentially want to look at. We'll talk in the next slide also about early adopting and perhaps getting rid of the forfeiture rate as part of the early adoption. So we're of the mindset that we should apply a forfeiture rate prospectively, meaning that we calculated as of January 1st, 2017, looking back either over your entire term, right? So maybe you've been giving options out for 10 years, 5 years, whatever it is. So looking back over that whole term, and then also looking back at some more recent times, right? Looking back over 2-3 years, has your rate changed in the last few years as opposed to going back 10 years, and applying that rate as of 1/1/17 prospectively. So calculating a rate of, let's say, 10% or 5%, and calculating that for 2017. Another methodology, it's also widely accepted, is looking at the end of 2016, calculating your rate and applying that to your expense in 2016. Again, our opinion based on the guidance is that the forfeiture rate is an estimate of future turnover, and so we should be applying that prospectively, but there's nothing wrong with applying it retrospectively as well. And the consideration is also, when you do this analysis, whether you need to bifurcate your population between executives and maybe non-executives, or we've had clients where they have high turnover in certain countries. So they have a higher forfeiture rate in India, for example, versus the rest of the world. So that's another consideration you want to look at. And there's different methods of how you apply that forfeiture rate. So you want to make sure you understand from a system perspective how that rate's being applied, either on a flat rate basis or on more of a dynamic or hyperbolic basis. So talking about the new guidance, right? So this guidance, if you're a public company, you will have to adopt it as of 1/1/2017. If you're a private company, you'll have to adopt it as of 1/1/2018, but can elect to early adopt it. We recommend early adopting it in the beginning of your fiscal year, whatever that is, if that's 1/1/17. If you are going to early adopt it at the beginning of your fiscal year. Otherwise, you have to restate your financials. So here's some of the high-level impact. One of the biggest impact of the new guidance is on the tax side. So it's going to reclassify all of the DTA, everything that went on the balance sheet or the APIC pool, which is off balance sheet, is now going to flush through the income statement from a tax perspective. So if you are thinking about early adopting, you definitely want to discuss with your tax provider, your tax professionals. If you're in a VA evaluation allowance, and this might not apply to you necessarily as far as the impact, but you definitely want to talk with your tax professionals. Additionally, there are some changes if you do withhold to cover, how you report that on the statement of cash flows. We don't see withhold to cover that often, but that's an item to check, to review. The forfeiture rate, as we talked about, you can now make a policy election to no longer apply a forfeiture rate. So our forfeiture rate is a haircut at the front end of a grant, right? If we grant an option, we're going to take a 10% forfeiture rate. That means we're not going to record 10% of that expense until it fully vests. And so we can actually eliminate the entire forfeiture rate analysis process and just the calculation of a forfeiture rate if we elect to apply a zero rate and true up upon forfeitures. We are encouraging clients to do this. It just simplifies the world in many respects. If you do this, you have to take a hit to retain earnings in the period that you adopt. So that is something to consider. Another big change is that you can now withhold taxes at the maximum statutory rates as opposed to the minimum. Previously, you had to record, if you did anything above the minimum, you had to record it as a liability for expense purposes. You had to record that award as a liability. And there are a few additional private company simplifications in the essence of time I won't be able to touch, but you can review those. I recommend if you are planning to be a public company, I would be careful in adopting some of the private company specific guidance because ultimately as a public company, you'll have to adapt or adjust to tackle that.
Fantastic, Scott. So let's shift a little bit, and I know we've talked a lot about the equity side of things. Let's hit a few other sort of high-level elements. You know, typically particularly in the outsourcing practice that we're working with smaller companies, emerging companies, private companies, some with CFOs, some who are using accountants or outside services or bookkeepers potentially, even to kind of keep track of the monthly financial information, and COOs and CEOs are end up being responsible for a lot of this financial information because they are the employees ultimately accountable for this. So I think it's really important just to kind of have an understanding and making sure whether you're preparing for a year-end audit or really your year-end taxes or really just really general best practices, it's really important to make sure that your overall books are in order. Our best practices, you know, generally we can communicate to clients that companies should really possess an electronically organized set of work papers to support all aspects of the financial statements and particularly all elements of the balance sheets. You know, we also recommend that the CEO or COO review the documentation on a quarterly basis. So here's a bit of a punch list of items to consider, particularly, again, in smaller companies, and what we've seen, particularly when we take over books and records, is we see that the previous person, whether it's a bookkeeper or perhaps a less experienced professional, yes, they're keeping the P&L up to date, but they may not have all the bank reconciliations up to date. So it's important to keep that number one on the list. Making sure that we have reconciliations for all the other balance sheet accounts. Making sure that there's an accounts receivable aging supporting what's that incoming cash flow. Making sure that they're not old and outstanding invoices out there that need to be collected. Really looking at the prepaid expense, making sure it's getting amortized over the P&L on a proper basis. Looking at your intangible assets, particularly if you're an intellectual property organization, you know, being able to, or goodwill or any other intangible asset, making sure you have an amortization schedule to support that. Making sure, again, if you're more of a product-based business, year-end inventory counts and reconciliations, supporting schedules for that, or supporting verified counts through an independent auditor or party. Making sure that you've got an accounts payable aging. Are there debts, and are there old invoices out there? Are there some things out there that you don't have your eye on the ball if you're not looking at this aging? And obviously some of the accrued interest and schedules on notes payable and making sure that that's all up to date. And we've talked a lot about the equity side of things and investing side of things, but also equity tables, just the equity table management as well. So make sure it's good to have confidence in your accounting professional and trust them, but it's also very important to verify. And then there's elements beyond the balance sheet that's really important as well. So making sure that you've got all the file backups, you know, all the logins and passwords are properly documented and secure. Making sure your business has some kind of disaster recovery plan in place. Looking probably more on a day-to-day basis, looking at your internal controls. Do you have the proper set of separation of duties, right, to really mitigate the risk of fraud or other improprieties going on? And then do you have all that compliance documentation that we've sort of talked about throughout this process? So
yeah, I was just going to add, David, I think that last piece about getting your process and procedures and that documentation in order. You know, obviously your year-end, you're working on closing the books and all of those things and maybe preparing for audit, but it's definitely an opportunity to at least, as you're doing those things, do you have procedure manuals, process documents that are up to date? You might not be able to update them, you know, 100% in the moment, but can you take notes and remember, hey, this is different than what we did last year, and you know, maybe when things calm down post year-end, then you go back and update those things. Because it's important, especially if you have a single source of you know, accounting managers or CFO or whoever, controller. If you have a single source, right, you want to make sure that you have that knowledge, that brain share spread across the organization or documented.
Yeah, it's a great point. We've had clients who've come to us and asked them to help with that, particularly if you're that single point of contact. feel free to reach out to a professional. Have somebody come in and kick the tires, right, and make sure that you've got the documentation or help you get that documentation pulled together. Because chances are, certainly all the information is there. You just want to make sure that you've got it pulled together, and most importantly, you really don't want to have any surprises going into your year end. This is really the best time of year to do a lot of this type of work going into year end, so that when you get into the year end and you get into the craziness of audits or investor updates and things of that nature, it's best to get this pulled together and documented as
Yep. Let's jump to the next polling question. We want to get to all 4 of our questions, so let's go ahead and launch that.
Thanks, David and Scott. So polling question 3, again, make sure you answer this one in case you've missed one. Are you planning to adopt the new ASU 2016-09 guidelines in January 2017? A, yes, B, no, C, not sure. Get those answers in, and we'll close the polls here in 3, 2, and 1. Looks like over half aren't quite sure, Scott.
Yeah, and we're happy to have a conversation about this. Again, I think the biggest impact is a little bit more on the tax side, so you want to talk to those professionals. And there's no reason if you don't have to, obviously if you're a public company, you have to. If you're a private company, there's no reason to necessarily that you have to early adopt. There might be some benefits. You just need to do that analysis.
Okay, so let's shift into business planning and business leadership, and we'll move through this pretty quickly. I think really the key takeaway that and the piece that I want to emphasize here is a lot of based on our research. Currently the CFOs are spending 55% of their time in the accounting role, right? Doing a lot of this compliance work, doing a lot of this, being responsible for the transaction work, just getting what needs to get done, and they'd really like to be spending 50% of the time in the business leadership role, right? Today they're only maybe spending 25% of their time. And I'll tell you a great way to help you get to that next level is to really energize your business around a business plan, whether it's an operational business plan or a formal business plan to present to outside investors. It's a great way to get the business involved, and even if you've got a broader team, to get them involved and moved along. Let's go to the next slide. So how do you get, what's the benefits, or how do I get the most out of a particular business plan? I mean, one of the great things about the business plan is really an opportunity to convert your strategy for your business into actual tactics of how do we get these things done. You want to, in this process, you want to be able to include multiple levels and functions of the business, right? Full participation from all facets of the organization, the operations team, the revenue team, the marketing team, finance team. It's an opportunity to pull all parts of the organization together and really focus on the way forward. And it's not just about pulling together the, what's the revenue and what's the cost. It's also thinking about those KPI measures, those non-financial measures, right? The customer acquisition costs, or number of subscribers, or whatever the particular metric that's going to help drive your business, or number of customers, whatever that is, be able to sort of help quantify that and incorporate that into the plan. And then really one of the most important things in any plan is to make sure you've got milestones and deadlines around this plan, right? You don't want to have a business plan that takes 6 months. Is probably not going to be a great business plan. You want to make sure you want to get at it, get to it, get it done as quickly as possible. 30 days, 30 days, 60 days is generally a good timeline to get the right level of input and buy-in into that process. I think the other thing too is in talking with clients, we talk about stretch targets versus achievable targets. Very much making sure you want to have a plan that's achievable, right? You want to feel like you've achieved your goals. It's okay to set stretch goals, but you want to make sure you have something that your business is going to achieve and it's going to help you get to that next level, particularly as you use this plan to help manage your cash flow and what you think is going to happen. And you also, one of the big benefits of the plan and one of the ways to get the most out of the plan is to link your compensation plan to your targets and to your business plan, right? Nothing better than tying incentives to the plan. And then, as I mentioned before, for the finance and accounting team, use this as a CFO or a COO, use this as a professional development opportunity. Challenge your team to be able to put a plan together, to work with other parts of the organization, get them involved with the business. It's a great way. I can tell you as someone who's done accounting and finance for a long time, it is something. It's a great opportunity to be able to be challenged with that type of opportunity and to be able to succeed at that type of opportunity.
Just one comment, because I completely agree, David, linking the compensation to the plan targets. Just thinking from the equity perspective, just be careful, I would say, in linking equity compensation to some of those targets. You may cause yourself some accounting and administrative nightmare. Again, not that you shouldn't tie and business. The business should come first before the accounting. I completely live by that, but you just want to consider the impact if you are implementing certain targets and trying to create an equity award around those. You might give yourself some headache unnecessarily. So just something to think about in that process as well.
No, great point. I think it's where I've seen it most successful is tying those compensation targets around the top line targets or revenue targets, or again sort of KPI metrics in terms of customers and customer acquisition and things like that as well. But yeah, I 100% agree. Great point. So very quickly, just going over to the. I'm
gonna cut you off for a second. I'm gonna launch our last polling question quickly in case people have to drop right at the end, and then you guys can keep wrapping up.
Let's quickly go to the next slide. Quickly the next slide, because that's kind of important for the question.
All right.
I'm not gonna give the answer, I think.
Well, that's really nice.
So here you go, right? And I want to make sure we have time for everything here. So I think really my big takeaway is there's a lot of tools for this one in particular, and you can read the slide. There's a lot of tools out there. Excel tends to be the #1 tool for planning, but for larger enterprises, there are bigger and better tools out there like Adaptive Insights, which is one example. But really one of the big benefits of the business planning is it really helps you manage your cash. It really helps you understand your inflows and outflows, and if it has all the elements of the profit and loss, the cash flow, or the profit and loss and the balance sheet, you're going to get a really good understanding of what your cash flow is going to be going forward. Okay, sorry.
Nope, all good. All right, we'll just quickly launch this one and then we'll let Scott wrap it up. So last of the polling questions, which statement below is critical to the completion of a best practice 2017 business plan? It is a good thing that David went over that slide. Is it A, personnel plan, B, balance sheet, C, cash flow statement, D, all of the above, or E, not sure? Make sure you get those answers in. We'll wrap this one up pretty quickly. For those of you asking for slides, I will be emailing them to you tomorrow, so you'll get them very soon after this presentation.
Also, if we weren't able to get to any of your questions, we'll try and reach out to you directly in the essence of time. We'll reach out via email.
Perfect. We'll close this poll in 3, 2, and 1. Looks like all of the above got the best response.
All right.
Cool. All right, and on to you, Scott.
Yeah, quickly, I won't go through these, but again, as part of that business planning process, if equity compensation or equity is a key part of your structure, you want to make sure that you are also planning for your option pool, right? Do you have the right amount reserved in your pool as well as your shares authorized for any hires, right? So thinking about personnel, and also thinking about cash flow, right? Because options are usually a supplement to some form of compensation, right? Salary, cash that you're outflowing. Do you have the right amount in your pool? Also, thinking about the compensation brackets, right? Do your folks, are you going to be adjusting the average grant for different levels? Are you going to stick with options? Are you going to expand to restricted stock? Some of those things are definitely items to start thinking about. And we talked about it a little bit earlier with the polling question, but is that employee education? What are your plans if you do have an equity compensation program to educate your employees so that they get the most benefit? Because ultimately, it's an incentive program, right? You want them to get the benefit and feel the ownership and the investment in the company.
Thanks, Scott and David. So to wrap up, during the webinar, we've covered U.S. tax and reporting considerations, accounting items for year-end, system updates, FASB updates, and business plan best practices. If you've got any questions, do feel free to submit them now or reply to my email when I send out the slides, and we'll make sure that David and Scott connect with you. If you want to reach out to them directly, their emails and contact information are on the slides, which again will be emailed out to you in a moment. So thank you again for joining us. We thank David and Scott for their time, and we hope to see you at a future Armina webinar. Thanks so much.
Thanks, everyone.
Thanks, everyone. Have a great holiday season.